The Rebel Capitalist Show.
I wanted to start by going back to a story that you went over with Emil the other day about Salomon Brothers.
Yeah.
And because in my mind, that's where this whole thing takes off with the Eurodollar market and trying to get this collateral as an arbitrage play to make a spread on who knows what it is, a swap or some sort of derivative, and the derivative market takes over. And then that takes us to 2008, and that's when you'll kind of get into the weeds there.
That's probably a good place to start. The Salomon Brothers story to me was a profound one. So in the early 1990s, we had this primary dealer called Salomon Brothers, which is actually one of the most famous primary dealers, especially in the 1980s. They were maybe, you think about Michael Lewis's stories, Liar's Poker, and the things like that. They were written about Salomon Brothers, one of the first shops to take over, to really embrace the quantitative aspects of some of these financial things. But in terms of what was at issue was U.S. Treasury auctions. And Salomon Brothers was bidding for complete allotment. So the government would say, I'm gonna auction off, a certain amount of 10-year notes. And here comes, the Salomon Brothers auction desk saying, we want all of them. Whatever you're going to auction off, we're going to pay for them. And the Treasury said, no, we really don't want you to do that. We got to spread this out a little bit. And so they were kind of warned, hey, don't do that. Except they kept coming back and saying, we want all of this paper. Whatever you auction off, we'll take it. And they, finally the Treasury Department said, look, you're not allowed to. We're going to start putting position limits on, because this has never happened before. We're just going to start putting position limits on the auction. And the Salomon Brothers guy he kept ignoring it. In fact, he flagrantly violated these rules. And it was kind of like, why would he do that? And this wasn't a small thing, because after a while, he really pissed off the people in the Treasury Department. Not only did they name the rule after this guy, his name is Paul Mosier. Now that they named the auction limit rule after this guy, he kept doing it to the point where they're like, listen, we're going to yank your primary dealer status, which would effectively be a death penalty.
And he set up like fake accounts to do it, or he'd do it with customer accounts. I mean, it's like they were giving away free gold, or like they were giving away free money. So that's where you're like, okay, well, if they were giving away free money, then how? Like how was he turning it into
what's the
free
point?
Money? Yeah.
Right. That's what people couldn't figure out at the time. And I dare say nobody had figured out today either. Nobody could figure out why he would do this, to the point where Salomon Brothers had to be actually rescued by Warren Buffett. Warren Buffett had to come in and keep Salomon Brothers from getting the death penalty, because Treasury was really pissed. They were going to yank their primary dealer status, which would have put them out of business. And so, as you pointed out, this guy was, when the Treasury started making noises about yanking their primary dealer business, they started hiding some of their trade. They didn't stop bidding for treasury paper. They started using customer accounts and placing bids through customer accounts and making it look like these were indirect bids when they were actually for Salomon Brothers. And so this triggered not only, it triggered, first of all, this congressional backlash where Warren Buffett actually had to go before Congress and defend Salomon Brothers. This is the stupid actions of a rogue employee, as they put it. Except when you go back and read some of the literature, especially the Treasury Department, the OCC, Federal Reserve got involved after the fact and said, we need to kind of take a closer look at what's going on here. So they produced this really long, I think it was 100 some odd page report about what was going on. And they didn't just look at Treasury auctions. They looked at MBS auctions, agency auctions, Fannie and Freddie, those kinds of things too. What they found out was this kind of bid rigging and bid cheating was widespread. I forget the number exactly. I think it was 93 out of the maybe 100 dealers they surveyed had been caught doing this thing. They were keeping two sets of books. And so everybody was asking, why would they do this? Because there didn't seem to be any profit motive. Why would you care about, if you wanted a few extra $1 billion or $300 million in recently auctioned Treasury notes, where you can just go in the secondary market and buy it? You shouldn't need to cheat in order to get this on the run auctioned off paper. So there was something in the fact that these were on what we call on the run, which is recently auctioned off securities. Why were these so valuable that dealers in both the Treasuries and MBS were willing to essentially commit fraud in order to obtain this kind of paper?
Yeah, exactly. The conclusion has to be that they were making so much profit that on doing this that it somehow justified the epic amount of risk they were actually taking. So
yeah, and that profit wasn't on the specific buying of securities.
Right.
It was securing this the on-the-run treasuries that could then be used in the repo market to either lend securities or lend the treasuries to other people who might want them, but more so to fund your risky activities in derivatives markets or any other thing. Once you obtain the best quality collateral, you've essentially unlocked the highest possible leverage possible. And that's really what it was about. It wasn't about speculating or cornering the market on treasuries as it was getting the best repo collateral possible so that I have a stock of the best collateral that I can then use to expand my balance sheet, do all sorts of risky activities, because this is the best form of funding leverage possible. And that was really what it was about. It was this transformation from, the old way of doing things, money multiplier, take in deposits and make loans and those kinds of things. So this new wholesale global offshore format where you need collateral, you got derivatives, we got all this qualitative as well as quantitative expansion, at which the collateral part of it is the key to everything.
Did that show that that the Eurodollar market outside of the United States was growing bigger and bigger and bigger to where it was now maybe even larger than what we knew domestically and what we still think is the center of the dollar funding market, and that's of course the Fed. I mean, was that the genesis? And then where I'd like to go from there, Jeff, is something that I've been thinking about a lot lately, and that's velocity. As you know, if you look at the velocity the way the Fed measures it, let's say just whatever money supply measurement you want to use divided or taken into nominal GDP. But one of my videos recently, I said, okay, well, if we don't know the money supply, and this goes back to some of our conversations, and then how do we know that velocity was increasing during the 1990s? And maybe it was just the catalyst of Salomon Brothers increasing the money supply in the shadows. Therefore, when nominal GDP went up, it was a result of increased money supply, not necessarily velocity. And if that is true,
that's it exactly. What the Fed said was what we're seeing is velocity rising, but that doesn't mean velocity was actually rising. What that meant was, given their statistics, their statistics that were outdated, they said, well, velocity is rising. Well, what they knew, velocity wasn't rising. What they were really saying is, we have no way of measuring money, and look at what's happening here. Something's going on with the system that's telling us our ability to measure and monitor the monetary system is getting way, way out of whack. Traditionally, repo had been a way for securities and investment firms to finance their securities and investment business, right? If you're a primary dealer, you're buying bonds from the government at auction, it's very nice if you could buy those bonds and fund them in the repo market. It's a courtesy. It's an efficient way for primary dealers to meet their securities business capacities. Over time, however, especially with Great Depression era regulations in the 50s and 60s, banking system and even corporate customers started to experiment with different ways to get around those regulations, particularly Regulation Q, which capped interest rates. And what happened was more and more the banking system and their customers turned into the repo market to get better returns on money, but also then to use those repo balances in a real world way. Corporations began writing checks for example, on their repo balances, which meant that even though repo numbers, these repo funds, were outside of the M1 and M2 statistics, they were being used in the real economy in a very real way. And so if you don't notice that the repo market has become a real monetary market, you're looking at just M1 or M2, you're missing out on a tremendous amount of actual legitimate activity. And of course, that's what Stephen Goldfeld said that. And then we get up into the 80s and 90s where repo only grew and grew and grew and expanded to become an even more crucial part of the monetary marketplace. That's really what we're saying here. And velocity in these M's is you're missing out on what actually takes place in the economy. It doesn't matter what your textbook definitions are. It's what the system actually does. I mean, who cares if it's in your textbook? If banks are out there using these monetary forms that aren't in your textbook, then your textbook is outdated, and you need to do something about that. So, getting back to
there's a portion of, we'll call it money, that's in the sunlight that everyone can see and everyone knows is there. But then there's another portion of money that is in the shadows, that very few entities they may know about, but it's almost completely unquantifiable. And what the Fed and correct me if I'm wrong, what they do just to give themselves the feeling of maybe having more control than they really do is they just completely ignore what's in the shadows and kind of sweep it under the rug, pretend it doesn't exist, and then just exclusively focus on what we can all see in the sunlight. But in doing so, it's it leads to bad data going into their economic models, and therefore bad policy prescriptions, to say the very least.
You're exactly right, George. There's shadow money. And you said earlier, is that larger than the domestic sunshine money? Yes. In fact, even in the traditional Eurodollar format, a Eurodollar used to be a deposit of U.S. dollars on an account someplace outside the United States. Mm-hmm. Even just some of these traditional Eurodollar forms, forget the derivatives, forget repo, just Eurodollars, these deposit accounts outside the United States. By the end of the 1970s, those Eurodollar markets were already larger than the domestic money supply. And I'm talking about M1, not just M1, but M2. By the 1990s, they were a third to twice as large. Just Eurodollar deposits. So this offshore monetary system that's already a shadow because it's offshore, it's already in the shadows, was far larger by the 1990s than the domestic system. And what the Federal Reserve, as you pointed out, George, what they decided to do was, we can't figure this money out. We're just too far behind. We don't have enough information. There's laziness, some of it's intellectual arrogance. What the Fed decided to do was, okay, we'll take a step back from the monetary system. We're going to change the way central banks operate. We're no longer going to pay close attention to money. Instead, we're going to pretend, and we're going to move around the federal funds rate, and we're going to signal. We're going to try to drive the banking system, the real economy's expectations, so that we can pretend that we're in control, but we don't have to care about the details, right? We can control the banking system by moving the federal funds rate around. If we raise the federal funds rate, that signals to the banking system to tighten up. We don't know how they do it because we don't know any of this stuff. But if we raise the federal funds rate, we expect the banking system to respond because we're the big bad Federal Reserve and nobody fights the Fed and all this other stuff. And that's really what it was. It was the belief that we don't have to know the monetary details because we'll fly way above it. We'll send some signals into the banking system, let the banking system take care of the details. Obviously, the flaw in that arrangement was, it was obvious in 1997, 1998 with LTCM and that, the Asian flu episode, which was essentially a precursor event to what would take place in 2007 and 2008, which was, you better know something about the monetary system because if it starts to go awry, these signals aren't going to do you any good, as we found out in 2007, 2008. Maybe you do need to know something about the monetary details, which takes us back to the Salomon Brothers episode in 1990 and 1991.